Okay, gang, welcome back. Now, before we get started on our Lesson 2 discussion, I just want to do a quick recap on what we covered in Lesson 1. So, in Lesson 1, we talked about market structure, and specifically we talked about how to bring an objective way to determine the trend. We talked about support and resistance, how support is an area of over demand where buyers have stepped in the past. And then we also talked about resistance and how that was an area of oversupply and where sellers have stepped in the past. We discussed the PPT system, the 3 trade types that our clients learn, and most importantly, the LCP zones and how they guide all of my decision making in my trading. And then finally, gang, we talked about how having the PPT system took me from a struggling trader to a consistently profitable one. So now, gang, let's dig into Lesson 2. Lesson 2 is all about bringing structure to that chaos that we call the market. We talked about how the market is boundaryless. There are no rules. So we have to bring our own structure to the market. So here's what you can expect to learn in Lesson 2. We're going to talk about my aha moment with systematic trading. We're going to talk about what defines an edge. Specifically, we're going to dig into expectancy. Now, this may actually blow your mind what you guys will learn here in about 2 minutes. We're going to talk about how you can build your own edge in trading, and then we're going to talk about what gives the PPT system an edge. Remember, at the end of Lesson 1, gang, I mentioned to you that I was focusing on the wrong trading stats. The first question I would always ask myself about any trading system was, what is the win percentage? I thought I was actually smart asking that question. Gang, I'm telling you right now, it doesn't matter. And I'm going to show you proof. But first, let's talk about what an edge means. So here's what Investopedia defines an edge as. I'm not going to read the whole thing to you, but I have highlighted the most important part. An edge, it's anything that adds a few points to the winning side of an equation. That can build an edge that lasts a lifetime. So guys, here's what we're going to focus on. Expectancy. So let's define expectancy. Well, here's the formula. You're going to take your average win, you multiply that by the win percentage. That gives you your win expectancy. You're going to subtract that from the average loss times 1 minus the win percentage, which is your loss percentage, right? So that's going to give you your loss expectancy. So let's look at an example, guys. This is just an example. We have a system that has a 1-to-1 risk reward. There's no trade management, okay? I'm either going to make 100 or I'm going to lose 100. And it turns out that I've done pretty good in my analysis and I can actually win 70% of the time. So let's plug that into our formula. So I have $100, which is my average win. I win 70% of the time. I want to subtract that from the $100 that I lose on average, and then my loss percentage, which is 30%. So now what I need to do is I just need to subtract those two numbers. So 70 minus the 30 gives me my trade expectancy, which is $40 per trade. So what that means is over 100 trades, we'd expect to gross $4,000. Now that's of course before slippage and commission. So why is this important, gang? Honestly, why should you care? Because I'm telling you right now, if your current trading system has a negative expectancy, there's no amount of risk management, there's no trader psychology training that can help you. You flat out have a losing system. So let me ask you guys a question before we move on. How many traders in here would want a system if I told you had an 80% win percentage? Come on guys, participate with me. 80%, how many want it? All right, there they are. Okay, good, Alex. Yeah, 80% is great, isn't it? Guys, what kind of system might this be? Maybe a scalping strategy? Maybe you're making a little bit on your wins, but you're losing more on your losers, right? I mean, that's what you would see in some kind of a scalping strategy that has an 80% win percentage. So let's take a look at it. Here's our formula. Let's plug in our numbers. In this specific strategy, we make $50 on average per win, but we lose $120 on average on our losers. So let's plug that into our formula. That gives us a $40 win expectancy and a $24 loss expectancy. So if we subtract those, we get $16 per trade of trade expectancy. So again, what that means is over 100 trades, we expect to gross $1,600 before slippage and commission. So wait a minute. I have a higher win rate, and yet I'm making less money? But I thought a higher win rate meant more money. Gang, not necessarily. So you can now see why I said that I was focusing on the wrong trading stats. So let's look at another system. Now, here's one that I'm actually building. So we talked about ATR yesterday. It stands for average true range. And it's a way to base your stops and targets on volatility. Now, this system has a 40% win rate. How many want this system? Show of hands. Come on, guys. Hit me with a Y with a yes. In with a no. 40% win rate. Awesome. You guys are nailing this. All right. Let's take a look at the numbers. Here's our formula, right? So this particular system, when it wins 350. But it only wins 40% of the time. When it loses 150. But it loses 60% of the time. So let's plug that into our formula and let's subtract those two numbers. Guys, this gives us a $50 per trade expectancy. So over 100 trades, we expect to gross $5,000 before slippage and commission. So again, let's recap this before we move on. I introduced you to the expectancy formula and the importance of it. We looked at one system that had a 70% win rate, but it had a 1-to-1 risk-reward ratio. We then looked at a scalping strategy with an 80% win rate, but the risk-reward was unbalanced. The losses were higher than the winners. Finally, we looked at a 40% win rate system with just over a 2-to-1 risk-reward. You see what we did here, gang? We played Mythbusters. The myth is, most traders believe a higher win rate means a better system performance. Honestly, the only place that the win rate matters is between your ears. It's a mental game. Traders think they have to have a higher win percentage. And that's just not the case. I just showed you how the lowest win rate system produced the best expectancy. So now that we understand the importance of expectancy and statistics, let's just take the natural next step here and let's actually build a system together. All right, I got a strategy here, guys. It's a moving average strategy. And I'm going to tell you how simple it is. It uses daily bars. If the daily bar closes above the moving average, then you get long. If the daily bar closes back below the moving average, you exit your long. There's no shorting. It is strictly longs only. Is that simple enough? Now these are actual numbers, gang. We're going to look at the QQQs. For those who aren't familiar with this is the NASDAQ 100 ETF. Okay? We're going to look at the last 17 years. So this runs from 2000 to current. Now the number of winning trades, guys, is 13. 13. Losing trades, 38. My win percentage is 25%. It's actually quite a bit less than the 40% system we looked at. Now, I'm sure you can envision what the pie graph looks like, but it's pretty dramatic, so I thought I'd put it on here. 13 wins, 38 losers. Boy, that red sure eats up the screen, doesn't it? Okay, so now let's take a look at the total returns over 17 years. So here's what I'm going to compare. Let's say you're an investor, you have a money manager who is managing your money. And he recommends you just buy and hold. And for that great advice, he is charging you a fee every year. So you've been with this guy for 17 years. You've been in the NASDAQ since 2000. You rode through the crash in 2001. You rode through the housing bubble in 2008. And you are destined to ride through I don't know what the next bubble is. Probably the Federal Reserve bubble, right? So here's your return over the last 17 years. 83.5%. How many of you are getting excited about 83.5% over 17 years? Anybody? Come on, guys. No one's excited about 83%? All right, good. Okay, no? No? All right. Let's compare this to the moving average strategy. $242%. And what this means is, for buy and hold people in the QQQ, for every 10K invested, your 10K is now worth $18,350. In comparison with the moving average strategy, your 10K, every 10K, is worth $34,270. And that's a 3x better return on a percentage basis. So, gang, not only do you have a better return here, but you're also allocated to the market the whole time if you're a buy and hold investor, right? And under the moving average strategy, you're actually in the market less than half of the time. So out of that 17 years, you're in the market less than half of that time versus you're in the market 100% of the time with buy and hold. So let's now compare the drawdowns between the two systems. Max drawdown on the buy and hold, 83%. You had to sit through some stuff on this one, guys. That'd be pretty tough to stomach. Versus the moving average strategy, 28.4%. Okay, what I want to do now is I actually want to dig into the moving average strategy. And I want to compare the average winner and the average loss. And these numbers, we're actually going to look at the median to get rid of the outliers, okay? So let's take a look at the median win. It's 11.76%. That's the median win. Your median loss, minus 1.37%. Gang, that's over an 8-to-1 risk reward. And by the way, guys, I'm sure some of you are wondering, what are the rules for this system? Well, guess what? It's yours. It's yours for free. We're going to give this away. I'll tell you how you can get this system at the end of lesson 4. Now, gang, let's move in and take a look at the PPT system to see what gives it an edge. The PPT system has 3 simple but powerful rules. Let's review. If the high time frame chart has a bid zone only, then we're looking for longs only on the trading time frame. If my trading time frame chart has a bid zone and no offer zone, then I want to be long in the bid zone on the trading time frame. If the trading time frame has an offer zone or takes out the bid zone, then wait for a specific price pattern to enter long. So we're going to walk through one day of trading. Let's begin with our high time frame. That's where our analysis starts every time. So the purple circles, these are 3 trades that were taken this day. On our high time frame chart, we have a bid zone only. So we know that on our trading time frame, we're only looking for longs. Let's take a look at trade number 1 right here. Okay, let's go to our trading time frame. Here's our LCP bid zone on the trading time frame. Now here's an LCP offer zone. So let me ask you guys something. We just looked at the rules. Do I want to be a buyer right here? Yes or no, guys? Okay, we got mostly yeses coming in here, and that's okay, gang, because this is the first time you're seeing the system. But remember one of the rules. If my trading time frame has an offer zone or I break the bid zone, then I need a price pattern. So gang, we have an offer zone. So it's simple. We're not taking a trade there. We must have a price pattern to take a trade. Let's see what happens. Ooh, it kept us out of a losing trade. Remember, here was the prior bid zone right there. And here was our prior offer zone. Okay, this is where the bid zone is now taken out. So gang, what I'm doing here is I'm going to follow price down, just waiting for my price pattern, okay? And as I get new offer zones, I'm taking out the prior, I'm deleting the prior offer zone, and I'm using the most recent. So let's just walk through this. My bid zone's taken out, so it goes away. I get a fresh offer zone right here, so my prior offer zone goes away. As price moves down, price puts in another offer zone right here. So I can delete the prior offer zone. And so I am waiting for my price pattern. And guys, at this point, many systems would actually consider this a new downtrend and begin looking for short entries. But we know we're still looking for longs because of our high time frame. And we know we're looking for a price pattern. So where's the next trade? Well, guys, it's a money pattern or a weaker low. Let's take a look at the next part of the chart. I want to bring your attention to this area right here. Here's where our money pattern confirms. Here's where the long entry would come in. And you guys know that I manage my stops aggressively. So once I get 10 ticks of MFE on the trade, my stop is going to start trailing with these dots. So it just so happens that on this trade, it stops me out. I lose 1 tick or $10 per contract. Guys, risk management is a key piece to what I do with the PPT system. The initial risk was 15 ticks. With aggressive risk management, I only lost 1. Yeah, I cut my risk by over 90%. So what do we do now? We're out of the market, right? We had a trade. We're no longer in the market. We wait. Remember, we talked yesterday about the power of patience. I'm curious, how many of you know exactly where your next trade is? Come on, gang. Y for a yes, N for a no. Be honest, please. Oh, good. We got, about half and half. All right. A lot of people saying no. Hey, I was right there with you not long ago. Okay, gang, now let's take a look at the next signal. So let's go back to our high time frame chart and let's review trade number 2. But first, let's review the rules. Remember, if the trading time frame has an offer zone or takes out the bid zone, then wait for a specific price pattern. Here's our trading time frame. We have an offer zone. I want to bring your attention to this area right here. Here's our money pattern. This bar is my confirmation. I would enter the market at the open of the bar after this one. And let's review and see what happens here. Price goes straight up, hits our target at 15 ticks for $150 per contract. And look what happens. The trading time frame puts in a fresh bid zone. Well, why is that important? Because remember, if I have a bid zone, then I can get long in the bid zone, unless there's an offer zone above me. So, where's our next trade? Let's take a look at our high time frame chart. Here's trade number 3. Let's review our rules again. Remember, if the trading time frame has a bid zone and no offer zone, I want to be long at the bid zone. If the trading time frame has an offer zone or takes out the bid zone, then I'm waiting for a specific price pattern. Let's look at our trading time frame. Here was that new bid zone. We have an offer zone. So guys, it's your turn. Do I want to be long? Right there. Amazing. Everybody's getting it right this time. Guys, this is simple. Instead, look what happens. I get my money pattern. So let's compare this trade right here with the very first trade that we saw. Remember the first trade? I had this exact same scenario where I had a bid zone, but I had an offer zone above. In that trade, we never got long because it never gave me my price pattern. But this trade actually does give a price pattern. It gives a money pattern. So we get long on the open of this next bar after this big green bar. So let's take a look. Here is our long entry confirmation. Here's our exit for 15 ticks profit or $150 per contract. So let's review the 3 trades. The first trade, we had a 1 tick loss or $10 per contract. Trade number 2, we had a 15 tick win or $150 per contract. Trade number 3, another 15 tick win or $150 per contract. That brings the total for this day to 29 ticks profit or $290 per contract. For 5 lot traders, gang, that's a $1,450 day. Not bad. So let's review the benefits of systematic trading. Well, it will remove the emotional decision making in your trading. For example, it'll help you stop feeling that horrible feeling when you enter a trade and take a loss, but you can't remember why you got in the trade. You'll no longer take trades out of boredom. It'll help you stop taking those trades. You know, you're checking your email, and all of a sudden you glance at your screen, you think you see a pattern that you read about in a free PDF report, and you just jump in and take a loss. It'll get rid of those trades. You will no longer hold on to losing trades. You will have very specific rules for when to exit a position. In other words, gang, you will know when you're wrong. And that's okay. You'll finally have the ability to backtest. Now, gang, when you know your rules and they're all put together, you can backtest to determine if the system is profitable. Backtesting is imperative. This is what you need to build belief in your trading system. In fact, I'd be willing to say that if you're unwilling to put the time in and backtest, you're destined for failure. And then finally, gang, having a systematic trading system will allow you to determine if it fits your personality. So for example, if you're trading a trend trading system, you can't expect to make money in a sideways market. The bottom line here, when real money is at risk, guys, think about this. When real money is at risk, fear and greed will make you do irrational things. You honestly can't trust yourself. A trading system, well, it doesn't have emotions. The decisions are objective. So let's do a quick review of what we learned in lesson 2. I told you my aha moment was systematic trading. We talked about defining an edge, specifically expectancy. I showed you how to build your own edge in trading. And I showed you the PPT system edge. The key here, gang, is that I was always focusing on the wrong trading stats inside my trading business. I never had a system that was 100% objective that would allow me to test and truly define my edge. Now, I showed you a system that won 8 out of 10 trades and yet had a lower expectancy than a system that only wins 4 out of 10 trades. Guys, we played Mythbusters together. So let's review what you can expect to learn in lesson 3. Okay, this is my favorite lesson out of the 4 that we're talking about. 6 inches of risk. This is all about the 6 inches between your ears. The best $1,200 I have ever spent. Gang, I'm going to give this to you as a free gift. It cost me $1,200 to learn, and it transformed my trading life. How 15 by 15 changed my trading forever. Gang, this is all about risk management. That's it, gang. See you in the next lesson.